I'm Josh Bisman. I'm an associate professor of finance here at Loyola Marymount University. As usual, I'm here with my colleague David Offenberg, and we are back to talk about bonds and credit default swaps. And we want to also talk about a really cool trade that's been occurring using Russian bonds and Russian credit default swaps or CDSs. So we got to start, take baby steps. So David, can you explain to us what a bond is?
Yes, I love bonds. So here I've got behind me a Confederate War bond. I'm sorry, Civil War bond issued by the Confederacy, the United States. The way this works is that the investor would take $1,000, bring it to their local Confederate Treasury office, and they would get this bond with the coupons attached. And then every 6 months, they would bring one of these coupons to the office. They would get $40 back, and that would happen twice a year. So 40 plus 40 is 80. So this is an 80 over 1,000, 8% coupon bond. And then at the very end of the bond's life, the investor would clip the very last coupon and get the $40, but then they would also bring the whole bond back and trade it in for $1,000. And so that's how it works. You're lending the government, you're lending the company, you're lending the entity $1,000. You get the coupons over its life, and then at the end, you get your $1,000 back. Now, what would have been really nice for the investors in the Confederate States of America is if they could have had some insurance on this bond, right, Josh?
That's right. So that bond most likely defaulted, so they didn't get paid back. But there's a cool financial instrument called a credit default swap or CDS that essentially allows you to purchase insurance on that bond. So what you do is instead of buying the bond for $1,000, you buy the credit default swap. And what happens is if the default is a triggering event. So if the default occurs, you get paid back on the credit default swap. So you, instead of giving $1,000, maybe the risk of it is lower. So you give $400, and if there's a default, you would get 1,000 back. So you're basically betting against the bond.
Right. So credit default swap is a fancy way of saying insurance, right? It's just like car insurance, where if I crash my car because I paid for the insurance, the insurance company gives me money to buy a new car. Here, if I crash my bond, if my bond crashes, the insurance company gives me money that would repay the bond, right?
That's exactly it. That's exactly what's happening with the credit default swap. So it's essentially insurance against bankruptcy or default of the bond. And normally, when we have these bonds trading with the credit default swaps, we can sort of look at a very simple example and see how the pricing of the two should work together. And what's happening in this example, I'm going to use what we call just a zero coupon. So you buy the bond and you just get paid the par value at the end to make it simple. So let's say we have a bond, its par value is 100, the price is 90. So you're basically, when that bond matures, you get your $100 and you earn a dollar return of $10, which is about 11%. And this bond is also going to have a credit default swap associated with it. And that credit default swap is going to have essentially the par value of 100, but the price is only $15. So essentially what happens is, for this credit default swap, the CDS, to get paid, the bond itself has to default. And if that happens, you would actually earn a return of $85. This is a huge return, like about 565%. It's a massive return. Normally, so if you look at this, if you were to buy both the bond and the credit default swap, you're actually having a combined cost that's over 100, over the par value of the bond. So in this case, it would be, it's very unlikely that you would want to buy both the bond and the credit default swap because you're going to actually lose money on that trade. What's happening now in Russia, and we're just going to make up the numbers to sort of make this simple, is that the probability of default has gone up so much that the prices of the bond have just gone a huge decline. So basically, you could essentially buy a bond for $25 and get paid with the intent to get paid $100. This is a 300% return, very big return. But with that added risk of default, the credit default swap's prices have increased as well. And so in our made up example, the price of the credit default swap is about $55. That's giving you a return of 82%. And this is sort of an interesting situation now, because what we can do is we can actually look at the price of the bond and the price of the credit default swap and add them up. And so essentially we have a total of $80, with a guaranteed payoff of $100. If the bond matures, you get 100. If the bond defaults, your credit default swap pays you 100. So this guaranteed return is about $20 to about 25%. And the amazing thing about this trade is it's an arbitrage because it's a risk-free trade. But in both cases, you're going to get paid your $100. It's really just fascinating to see, and it's happening right now with a lot of Russian debt.
Yeah, so that's the interesting question: is it risk free? Is it really risk free?
Yeah, and so of course, it sounds too good to be true, and David has hit the nail on the head. When something sounds too good to be true, it probably is. And so there are some interesting dynamics with the Russian credit markets right now. So there are, there's potentially what we call limits to arbitrage, where you might have to hold both of these for a very long time before you actually get paid. It's unclear whether the triggering event is going to actually, so if Russia defaults, will that actually trigger your credit default swap to pay? The way some of them are written, it's not totally clear. And then of course there's as in an article that we'll put in the notes here mentions, there is a lot of hedge funds are wary of just being associated with making money off of Russia, sort of rightfully so. And so, that's also a piece here. So, there's potentially risk here involved. It's always tricky when you hear something's completely risk-free. And I think there's definitely some of those risks that we just mentioned involved here.
And I think this is a particularly fascinating arbitrage because so often the arbitrages that exist in the market are very small. Things that you can make with a few thousand or maybe a few $1,000,000 on, but this one's huge, isn't it?
Yeah, this one's really big. And so the numbers we used are made up, but they're not that far off. The combined amount right now is about is roughly about $80 per 100. And so you're looking at just potentially massive profits if you can actually pull off the trade.